Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
All right, good morning. Monday, October 21st, 10 more days left in the month of October as the year continues to move forward. Lots of noise, but our focus is on maintaining portfolios that are in alignment with our clients' goals and aspirations. So always try and keep focus, stay out of the noise. Want to also emphasize October 21st. We are rapidly approaching year end. So something for all investors to think about. Number one, required minimum distributions. If you hit 70.5 this year or over 70.5, you are required to take required minimum distributions from your IRAs. Clients and investors and advisors should be checking to make sure that all clients who are required to take distributions are doing so. Year-end tax lot selling. Brad Harris, head of fixed income trading last week, talked to some of you, sent out some correspondence regarding thinking now about tax loss selling. This is a year where we've seen the equity markets up significantly. We've also seen lots of bonds in the bond market up, but some investors may own legacy Puerto Rico bonds. There's lots of uncertainty, lots of litigation going on with respect to Puerto Rico. May be appropriate for select investors if they have losses in Puerto Rico to think about offsetting those losses with some of the gains that they have. Could be a wise tax strategy. It is, my opinion, now is the time to start thinking about strategies with respect to losses, because come year end, everybody's going to be looking for losses at the same time. There aren't a lot of losses this year. That's the good news. The bad news is there aren't a lot of losses this year. So what does that mean? That means that most investors will be looking to sell the same securities as the others that are out there, which means that securities that are at a loss will be at a bigger loss come later in the year, and good probability of that. So think ahead, act early, and take advantage of the best pricing on some of those securities that have declined. Also, as we approach year end, keep in mind, strong year in the equity market. We've had several strong years in the equity market, strong year in the bond market, several strong years in the bond market. What does that mean? It means that if you're purchasing mutual funds, investors, advisors, keep in mind, if you're purchasing mutual funds, you may be purchasing someone else's gains. So be mindful of year-end distributions for capital gains, dividends for mutual funds for clients, so that you're not purchasing a fund on December 1st and it's going to declare a capital gain on December 15th, and you didn't enjoy those gains, yet you are going to be paying the consequences or the taxes for those gains. Mentioned here we are, October 21st, going to talk about a interesting article that I looked at over the weekend, and it has to do with lots of changes taking place within the financial services industry, and how the financial services industry has some parallels to what's taking place in the retail marketplace. And this is a nationwide phenomenon. Here today, this morning, I'm with Larry Hayes in the office right outside Chicago, and just as pertinent here as it is anywhere else, New York, San Francisco, Chicago, Houston. Lots of changes taking place in our industry, and even though clients and investors are located in different locations, the needs are the same. So providers of services in the financial service industry need to take a look at the changes that are taking place so that these advisors can serve their clients in the next decade. Investors are changing the industry. Just this morning, we saw another firm, Bank of America Merrill Lynch, at their Merrill Edge, announcing that they will be offering no fee or commission-free ETF and equity trades. Not a dramatic announcement. About 85% of the customers already at Merrill Edge weren't paying a commission or a fee for those services. But now, if you're doing those trades electronically there, the other 15% will also not be being charged for online equity transactions. Again, want to emphasize online, not talking to an advisor. Currently, advisors are caught up in the day-to-day tasks, and they are not devoting the time and resources to future planning. The sort of the scary news is that the rate of change that we're seeing now is probably as slow as it's going to be over the next few years. So the rate of change is only going to accelerate. Recently, there was a survey of 436 financial planners, 686 investors, and what this study was looking to do was to see what advisors needed to do to remain relevant and successful over the next 10 years. Many advisors recognize that technology can help increase efficiency, but less than one quarter have plans of adopting new technology. They may say they'd like to adopt it, but do they actually have a plan? Only one quarter. Even perhaps more interestingly is that in terms of a business plan, forget about a technology plan, but a business plan, only 55% of advisors, actually 45% of advisors have a plan. 55%, got that backwards, have no plan. Also interesting is when clients were asked what services are they most desirable of from their financial advisor. The number one answer was something that helps them to learn more about the financial markets. When asked to elaborate, they said educational material, perhaps even on the technology side, something in the augmented or virtual reality space is something that they would be interested in. Other clients said that they'd be interested in chat boxes when they are on a website, about 15% of clients. Also interestingly, about 15% of clients said that they would prefer video conferencing as one of the top technologies that they would prefer. Interesting, what's at the bottom of the list? At the bottom of the list is an online portal to manage accounts. Lots of talk of portals to see all your assets in one place. Advisory firms striving to provide those services, clients saying not as interested as you think. Also, clients saying not as interested as you think in enhanced performance reporting. Clients would like to know how they're doing, but they are not. In fact, about 1% of clients said, one of the least cited technologies, about 1% of clients said that they would like to see an enhanced performance report. When advisors were asked, what is going to drive your future growth, 77% said referrals, 50% said centers of influence, and 31% said educational events. Interestingly, almost none said what the experts view as perhaps the greatest potential for advisors to grow their business, and that is by expanding services with existing clients. So it is not necessarily about achieving growth by getting new clients. It's digging deeper, doing more with existing clients where the real opportunity lies. Most advisors are just scratching the surface, whether they're aware of it or not, with their current clientele, and the greatest opportunity is actually within the clients that they currently service, not outside where so many clients are seeking attention. Also of interest, one advisor who has adopted video conferencing via Skype and has made it available to clients has found adoption is significantly high even among clients who they may view as older or elderly. They, in fact, are amongst the biggest users of video conferencing because it's not necessarily easy for some of these elderly clients to get out of the house and come visit you in your office, or perhaps visit their advisor at a local coffee shop or Starbucks. Also interesting that clients who are busy, even if they live close, have chosen to participate in virtual conferences as opposed to face-to-face meetings. So what are some things to think about that advisors should be thinking about going forward? Number one, plan for more than 10 months. Plan how to structure business, not just for the next 1 year, but for the next 5 or 10 years. Experts recommend taking 2 days out of the year to focus on what changes and what the plan will be moving forward in order to serve investors better. So moving forward this morning, talking about the financial markets. Again, October 21st, where were we last week? Last week we saw the Dow fall 46 points, about 0.2%. The S&P was up about 0.5%. NASDAQ up 0.4%. Over the not over the last year, but year to date, the S&P is up 21%, Dow up 17, NASDAQ up 23, emerging markets up 9, foreign stocks up 15% year over year. Looking back at last week, we had some really good news, but it wasn't enough to get the market jump-started. Some other concerns emerged. But what do we mean by really good news? Well, we had the European Union and the United Kingdom agree to a draft deal on the elusive Brexit that now needs to be approved by the UK Parliament. News over the weekend that the Parliament deferred voting, and we'll see where that winds up. Possibility that there'll be a vote as soon as this week. Also, a possibility that the EU may grant an extension to the United Kingdom, possibly opening up the way for a referendum or a second referendum. So lots of possibilities. But last week the news flow regarding Brexit was encouraging. United Healthcare last week reported earnings helping out the healthcare sector, which has been one of the poorer performing sectors, actually the second worst performing sector after financials. And Barron's out over the weekend suggesting that both healthcare and financials may be a sector that will thrive going into year end. Last week, speaking about the financials, J.P. Morgan and Citigroup also reported better than expected numbers, and both indicated that they did not see any signs at the moment that the U.S. economy may be heading for recession. But as I mentioned, that was not good enough because we had some news that Turkey invaded Syria. Chinese gross domestic product grew at its slowest rate since the 1990s. U.S. retail sales fell by 0.3% in September instead of growing by a like amount, which was expected, raising concerns about the U.S. consumer. And then we had Netflix report earnings last week and go on a wild ride. It jumped about 10% in after-hours trading. It finished Wednesday, its first day of trading, up 2.5%. And by week's end, the stock was lower than where it had started at the beginning of the week, again on the streaming type concerns. Last week, the Dow I mentioned was the one index that was down. It was hit by the triple whammy of Boeing, Johnson & Johnson, and IBM. Boeing down about 8% last week. Emails showed an employee may have unintentionally misled the FAA. Reports this morning that Boeing regrets those actions. And some analyst commentary and downgrades this morning on Boeing. It's down about another 5 points or 1.6%. Also cut to a neutral from a buy at UBS Credit Suisse. Also, Johnson & Johnson down last week. Reports that they found some asbestos and some baby powder. That's a big deal. Because the reports that that asbestos and baby powder is what possibly was causing ovarian cancer, and J&J faces lots of lawsuits on ovarian cancer. And then we had IBM reporting disappointing sales, and the stock dropped about 6% to 134. Also, in Barron's, they talked about some weakness in IBM, possibly indicating enterprise weakness. They also cited Cisco, which recently had suggested that they saw slowing sales, possibly suggesting that enterprise spending is slowing down. We'll get a little bit more clarity on that with respect to earnings this week when we get earnings from Microsoft. Companies that are going to announce earnings this week besides Microsoft: Boeing, Caterpillar, United Technologies, Procter & Gamble, McDonald's, 3M, Amazon, Intel, Visa, Verizon. So a good cross-section going to be reporting earnings this week. The other big event besides earnings this week is the European Central Bank announces its monetary policy decision. The central bank is expected to leave its key short-term rate unchanged, negative 50 basis points. Yes, negative 50 basis points. Last interest rate meeting headed by ECB President Mario Draghi. His 8-year term ends at the end of October. He's going to be succeeded by Christine Lagarde, former head of the International Monetary Fund in Europe. Other news this morning, where do we stand this morning? We're looking at S&P futures. Last I looked, we're about 10 points above fair value after 2 straight weeks of gains in the benchmark index, and that's the S&P. I did mention the Dow was down. We talked about Brexit, but the European stocks market, European stock 600 currently up 0.4%. U.S. Treasuries have edged lower, pushing yields higher across the board. 2 years up about 2 basis points to 159. 10 years up 3 to 178. Dollar slightly weaker. Oil slightly weaker as well. We have pharmaceutical companies in the news this morning. They were lower with a trial getting started in Ohio, but a last-minute opioid settlement is being announced by the Wall Street Journal. Those stocks bouncing off their lows. So as those details come in, probably be some more volatility surrounding companies exposed to opioid litigation. Peloton in the news, recent IPO. PTON makes those bikes as well as holding fitness classes online. Peloton had 10 different firms on Wall Street issue buy recommendations this morning. Another upgrade this morning, Hewlett-Packard Enterprise, HPE, up about 2%. Bank of America Merrill Lynch raising their target to 29. Also this morning, saw an upgrade on Apple and a target of 280 on Apple. Just not recalling the analyst that did that upgrade this morning. Moving on to Barron's, a couple of stories in Barron's this morning. The headline story in Barron's had to do with something that everyone listening probably participates in to some extent, and that's television. And speaking specifically about television, the streaming TV revolution, and who the winners and who the losers are, and how to play the stocks that are impacted. And what Barron's concludes is that Comcast stacks up better than investors might expect, in part because for it, cord cutting is a misnomer. Comcast is a winner, according to Barron's, regardless of who wins, because of their broadband service. So whether Comcast is delivering their own service, if they're delivering Netflix, if they're delivering Disney, if they're delivering Amazon Prime, the conclusion that Barron's comes to is that Comcast perhaps is the best way to participate in streaming. They go through most of the streaming companies. They conclude that Disney is well positioned, that a flub, not that they're predicting one, in streaming would not dramatically impact the company, and a success would certainly be a cherry on top of the Disney story. They say that Disney right now is the favorite for at least the number 2 spot behind Netflix, and possibly over the years they say has the best chance of supplanting Netflix as the choice streaming company. They also point out that Apple, Amazon, and Alphabet, also known as Google, all can thrive with or without becoming larger TV players. They say AT&T, CBS, and Viacom are challenged but cheap, so they suggest they don't write them off. They think AT&T is reasonable for its current pricing and for its dividend, but not sure if you'll really see growth with Disney. And they do talk about Roku as being the long shot bet on a specific outcome, but sometimes long shots don't pay off. So just be very cautious and realize if that's the company that you're favoring in this space, that it's probably got the greatest reward, but certainly also coming with the greatest risk. Speaking specifically about Comcast, they point out it trades at about 14 times forward earnings. Comcast recently launched Flex service, which gives a free streaming device to broadband-only customers. So if you're a broadband-only customer at Comcast, they'll give you a free streaming device, which is sort of like a Roku or an Apple TV, which will enable you to access some of their quote-unquote competitors, but Comcast aware that you're using them for broadband. They've been raising the price for that broadband, and at the moment you need that pipe into the house, and they've got the best strategy according to Barron's to deliver that pipe. In terms of the vision that Comcast has for the future, they say the future, in their opinion, is television screen that is always on, sort of like an appliance. The TV is the biggest display in the home. In the past, you had to hit an on button, wait for it to turn on. But the prediction for the future is it's going to be the place that is the hub of the home. The television will always be on. It'll be the place where you monitor perhaps cameras in your home. You control the thermostat in your house. Perhaps you do video conferencing from it as well as watch television. A couple other stories. Barron's positive on ConocoPhillips stock, and saying it looks cheap after a sell-off. Talking about specifically the energy industry, they point out the energy industry is clearly not in favor. Symbol on ConocoPhillips, by the way, is COP, Charlie Oscar Paul, COP. Story here is ConocoPhillips, which soared to as high as 80 2 years ago, and is now trading around 55, given the recent rout in energy and production companies. Also citing that some of the energy companies have been hurt by the theme of socially responsible investing, as well as fears about the future of oil and gas. But Barron suggesting at the current price levels, they think ConocoPhillips is appealing. 3% dividend yield at the current pricing point, and they suggest that ConocoPhillips has a leading position in the Eagle Ford region of Texas, strong balance sheet, low production costs. They recently raised their dividend. They also have a share repurchase program. They're looking to repurchase $3.5 billion in stock this year, a little less next year at about $3 billion. And the dividend boost reflects what the CEO has called a hyper-focus on shareholder returns. CEO Ryan Lance citing 5 priorities: sustain output, pay the current dividend, increase the dividend, maintain an A credit rating on their bonds, and pay out 30% of annual cash flow from operations. Stocks trading around 14 times earnings, which is less than their competitors Chevron and Exxon Mobil. But they point out that ConocoPhillips is more diversified than many companies in their space. I mentioned the Eagle Ford site. They also have energy production going on in the Bakken region, the Permian basins in the U.S. and Alaska. But they also operate oil and gas exploration in Canada, and they have lucrative stakes in liquefied natural gas in Qatar and Australia. If you're worried about oil prices dropping, they talk about the fact that the CEO cites that if oil were to drop to $40 a barrel, that would kind of be the cutoff level where perhaps the dividend would start being in jeopardy. One thing to think about, important article in Barron's, Medicare, and what investors and what advisors should be talking to clients with respect to Medicare. Critically important once you become eligible. And next year, Medigap Plan F will end. Something to keep in mind when talking to clients. Now, Medigap F, if you're not familiar, is the plan that clients can choose when they sign up for a Medicare plan, a Medigap plan, and Plan F is the plan that covers 100% of the costs of medical coverage. That when I say 100% of the costs, it's doctors and hospitals visits. It is everything except vision, dental, drugs, and equipment such as hearing aids. No deductibles, no co-pays, no bills after a person has left a doctor or hospital. No approvals necessary to go to a specialist, and even in many cases, overseas coverage is covered. But the no-fuss nature of Plan F has prompted some changes. These plans are sold by private insurance companies, but the federal government sets the rules, and the government is trying to prevent overutilization of medical services, so they are eliminating Plan F. If clients currently have Plan F or investors currently have Plan F, they can keep it. but going forward, Plan F will no longer be an option. So what is a client to do? Probably the second best choice is to choose Plan G. Plan G is identical to Plan F with one exception. People must pay deductibles before insurance coverage kicks in. Deductibles right now fairly modest, but some analysts are predicting that those modest deductibles will start rising as the Medicare overseers start wanting Medicare recipients to have more skin in the game so that they are not utilizing medical services as freely as they currently are. When I say freely, meaning, well, it doesn't cost me much, doesn't cost me anything, I may as well get that test. More skin in the game, people take more responsibility for their choices. Perhaps if it's going to cost them a few more dollars, they may feel that that test is unnecessary. Something to see where the ball is going with respect to Medicare, which means over the long term probably greater cost, higher expense for medical coverage in retirement. What does that mean? That means investors, clients need to be able to plan better, to have more income, more cash flow in retirement in order to meet potentially higher medical costs going forward. That is everything that I have this morning.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.